The stock market is more concentrated than it's ever been. The top 10 biggest US companies now make up nearly a quarter of the entire global equity market. The last big spike in market concentration occurred around the dot-com bubble in 2000, and before that in the 1970s. In both of those cases, these spikes in concentration preceded a major shift in market leadership. There seems to be a pattern. A bull market drives a handful of leading companies to new heights, their weighting in the index expands, and concentration rises. Then, historically, a recession comes along and reshuffles the deck, allowing new leaders to emerge. In this video, we're going to take a look at the current market leadership and what it tells us about the longevity of the bull run we're seeing today. How much optimism is already priced in? How much room and time for growth is there left when we compare it to similar moments throughout history like the Nifty 50 and the dot-com bubbles? First, let's go back to the 1970s. After the 1970 recession, a group of about 50 large-cap stocks began to soar. They became known as the Nifty 50, widely seen as solid buy-and-hold-forever companies. Think Coca-Cola, Disney, and Procter & Gamble. The Nifty 50 led a massive market rally. By the end of 1972, the concentration of the top 10 stocks in the S&P reached a high of around 28%. But then came the big change. A deep recession came around in late 1973, and the market began a dizzying descent. These high-flying stocks with extreme valuations got crushed and went on to underperform the broader market for the next decade, clearing the way for new leaders to emerge. Fast forward to the late 1990s. Following the 1990 recession, a new group of tech darlings took over. Companies like Microsoft, Cisco, Intel, and Oracle were the must-own stocks of the new internet age. They massively outperformed, leading a huge market melt-up. By the peak in March 2000, market concentration was again at an extreme, with the top 10 companies reaching around 23% of the S&P by market cap, and once again the pattern held. The bubble burst just as the economy was heading into the 2001 recession. The dot-com leaders collapsed, and many took over a decade to recover. This allowed a completely different set of companies to lead the market after the 2008 financial crisis. There seems to be a pattern. Historically, recessions have often acted as a reset button for market leadership, but that may be changing. Just look at today's market. The current leaders, Microsoft, Apple, Nvidia, Google, and others, have dominated for much longer than their predecessors. They've been on top since just after the Great Financial Crisis, more than 15 years ago. Their outperformance has been relentless. There have been only a few notable blips: the 2020 pandemic recession, the 2022 bear market, and the 2025 tariff-induced market crash. None of these have shaken the market leaders from their position on top. Instead, they've just grown stronger with the rise of AI, which has only powered the ascent of megacaps even more, pushing concentration to new highs. So why hasn't this bubble burst like the others? One key argument is valuation. Just look at forward price to earnings ratios, which are based on analysts' expectations for future earnings. During a bubble, these expectations can become disconnected from reality. The tech sector in the early 2000s saw a massive spike in forward PE ratios, peaking above 50. Today, the forward PE ratio for the tech sector sits around 30. So while current valuations are certainly elevated compared to long-term averages and show an upward trend, they're not yet at the extreme levels seen in March 2000. This suggests that while there is optimism priced in, it's not the same kind of speculative fear we saw back then. However, elevated valuations still mean there are high expectations for future growth. They just need a catalyst to challenge those expectations. And historically, that catalyst has often been a recession. A recession flips the script. In an economic downturn, investors typically flee from expensive, high-growth stocks and seek safety in more defensive areas. This can cause the market's biggest and most expensive names to underperform, breaking the concentration. You might point to the 2020 COVID recession as an exception, and you'd be right, but that was a unique event. The recession was incredibly short, and the massive government and central bank response actually accelerated the economy's shift to technology, strengthening the megacap's dominance. The simple reason the historical pattern of leadership rotation hasn't completed this time may be that we haven't had a typical business cycle recession to trigger the reset. This leaves us with two very different potential paths forward, for the stock market and for the top 10 megacaps themselves. Scenario A is the soft landing. In this scenario, the economy avoids a full-blown contraction for the foreseeable future. The dominance of the megacaps is seen as justified by their strong earnings and leadership in transformative technologies like AI. Concentration could remain high or even climb further as these companies continue to deliver. Scenario B is the classic reset. In this scenario, the economy finally does tip into a traditional recession in the coming months or year. This would likely validate the historical pattern. The high valuations of the megacaps would make them vulnerable, leading to significant underperformance and finally causing a rotation into new, cheaper market leaders. This would be a repeat of the 1970s and 2000s playbook. So what does today's high market concentration signal to investors? It suggests that the conditions for a potential leadership shift are in place, similar to past cycles. However, the unique post-pandemic economic environment may have delayed the traditional outcome. The key indicator to watch now is the health of the economy itself. The direction of growth and the risk of a recession will likely determine which of these scenarios plays out. For investors, this means the debate isn't just about AI hype versus valuation. It's about the business cycle. At Capital.com, we'll keep you updated on market concentration and the risk of a recession with videos like this one. Hit like and subscribe to stay tuned. Thanks for watching.